Hello, ACCA Financial Reporting students. I welcome you to this presentation on question number one, the question which was part of your week 2 assignment. And I hope the presentation is going to take you a long way in understanding this International Accounting Standard, that is IS1, okay, presentation of financial statements. All right, we have already learned that this accounting standard was meant to bring a standardized process in preparing financial statements. So we are introduced to uh, four main financial statements, which are the statement of profit or loss and other comprehensive income, okay, OCI. So SPLOSI, the statement of uh, profit or loss and other comprehensive income, and then the statement of financial position. All right, and then there are two other financial statements, which are the statement of changes in equity. Okay, statement of changes in equity, and then lastly the statement of cash flows. All right, but there is also another part, that is the note to the financial statements. Notes to the financial statements. So you need to know that a full set of financial statements include all these. So it's a combination of these five aspects. All right, now knowing this background, we just have to go through question number one, which was asking us to prepare some of these. Okay, so this is the question, ladies and gentlemen. You were given the question, and as I've always said, that if you're a student, you're not only going to watch videos. Our students get both the videos, the assignments, and the reading materials. There is also an opportunity for you to speak directly to the tutor on WhatsApp platform, which is actually very cost effective in most jurisdictions globally. So please feel free to just become a student, our student. All right, and these are my numbers. If you, these are the contacts. This is the cell phone number. It's a direct line, and you can as well chat on WhatsApp with me 24/7. WhatsApp 24/7, which means any day, anytime. I'll always be there as long as the Lord keeps giving me the strength to work. All right, you can send an email to me on this so that maybe we can engage. All right, without much ado, let us then, this is the question, as I've already indicated. We are given the information, that is the list of account balances as at 31 December 2007, and they have been prepared by an accountant at Wilson Camban, okay, who has prepared them. So that's the list of account balances. So is not the norm. This was prepared in just a list of balances, okay? Usually students could be accustomed to a trial balance that outlines the credit and the debit, but this is just a list of balances where you just have to lead yourself, okay? At paper financial reporting, the students are assumed to have gathered the ordinary knowledge about these elements of the accounting elements. Okay, you're assumed to be knowing much of your accounting at skills level. All right, so that's the assumption. So the examiner just presumes that you know that ordinary share balance, the balance for ordinary share capital is a credit. You know that, okay? You just have to know that. All right, and then 10% loan notes. Loan notes are non-current liabilities, and you also have to know that these are credit balances. right? But that is actually not important for now. You just have to then know what was the question requirement. So in an examination, when you look at the financial statements given in the question, you just have to first to rush to your question requirement, so that whenever you'll be studying the figures, you'll be knowing what is being required. So this was the additional information, ladies and gentlemen. As part, you can pause the video so that you can read the additional information. But let us first go straight to the question requirement. Now, the question requirement was that you were supposed to prepare the financial statements of Wilson Company as at 31 December 2007. All right. You do not need to produce notes to the statement. So you are not required to produce the notes. So the notes were out. Okay. And you are also not required to prepare for the purpose of this video. We are not going to prepare the statement of changes in equity as well as the statement of cash flows. These ones, we are not going to prepare them. All right. So this means that we are only going to prepare two, that is the statement of profit or loss and other comprehensive income and the statement of financial position. So these are the two which we are going to prepare so that we shorten our task. All right. Now, it is not an issue of just knowing the format of these two financial statements, but you need also to know the elements, right? When I'm talking of the elements, just have to know the key figures. For the statement of profit or loss, the key figure is the revenue, then the cost of sales. Okay, then you get your gross profit. From there, you then have to say gross profit less operating expenses. All right, operating expenses. Okay, these can be grouped into the admin expenses, the mainstream operating expenses, and so forth. Right. Sometimes the examiner might want you to show distribution expenses and so forth. All right, then you get your net profit. Then when it comes to the statement of financial position, know that this is grouped into two or three parts. Okay, there is the asset part. Remember the accounting equation: assets is equal to capital. All right, capital plus liabilities. Asset is equal to capital plus liabilities. That's the accounting equation. So the balance sheet is actually made up of these three components: the assets, the capital, and the liabilities. All right. So what it means is the assets have to be equal to the total of capital plus liabilities. All right. So the other part of the balance sheet speaks of the assets. The other one speaks of capital plus liabilities. So you see that in the assets, we have got the non-current assets as well as the current assets. Then on this side of the equation, we have got the capital, that is normally called share capital. Okay, and then we have got the non-current liabilities and the current liabilities as well. Okay, so that's what you should be knowing in your head as you'll be reading through the question. All right, now let's move on to the issue. Now let's start with the items of the statement of profit or loss. Sometimes the examiner might be very straightforward, giving you the figures for the revenue, sometimes giving you the figures for the cost of sales in the list of balances. But usually you need to lead yourself to know sometimes the figure provided might need adjustments. There are things like adjustments which you need. There are a lot of adjustments to be done. Sometimes this might be related to accruals and prepayments. All these things, we did cover them in earlier papers. In the earlier paper, the financial accounting paper. Okay, you need to adjust sometimes on things linked to the cost of sales might need to be adjusted. Sometimes issues linked to the computation of depreciation itself. Depreciation on net book value of assets. Sometimes you might need to make some adjustments. So there are a lot of adjustments that have to be made. Okay, sometimes the inventory values, okay, inventory values might need to be adjusted. Okay, remember inventory is valued at the law of cost and NRV. Okay, sometimes the managers were doing it wrong, and you need to make sure that you adjust for such things. So adjustments are actually a key in this paper. You need to know when adjustments are needed. Sometimes there could be some errors in posting, right, where the error of principle has been committed, and you then have to know how do I have to adjust. So those are the things an accountant should be prepared to do. All right, so now we are given the figures. Okay, these were the figures as I have already indicated. All right, this was our question. Okay, you just have to scan past these figures, right? Like for example, you are seeing that some of the figures could be of interest. For example, this one, okay, the loan notes, 10%, 10% loan notes, okay, and we are told that they were of a value of 200,000. Okay, they were for a value of 200,000, which means the interest component, the annual interest. Remember, you need to prepare your notes, all right, in the notes or your workings. So you can actually say that in your workings part, okay, workings is a working, right? You can see here that the loan note were 10%. We're attracting an interest charge of 10% per annum. So the interest, just have to say interest, all right, or interest charge. The interest charge per year was 10% multiplied by, remember it's 200,000 multiplied by 200,000. So which means the charge for the year was how much? 20,000. That's your working, okay? Now you then have to say, if you look down this the figures, you can see that they said something about the interest here. The interest was 10,000, which means they paid only $10,000, but the charge is 20,000, which means we are having an interest accrual. So you just have to come here and say, therefore, all right, let me just rephrase that. I don't like all right, sorry, let me just try to adjust my screen. Okay, yes, I think now, all right, where's the pen? Okay, I need this eraser. Just forgive me for that. All right, so now we are aware that 20,000 was the charge. So you come down here and say amount paid was 10,000. Okay, you can just say but amount paid was 10,000. So therefore 20,000 minus 10,000 gives us 10,000. This is the accrual. accrual. Okay, so this is the accrual or interest payable. Why is it an accrual? Sorry, I don't mind my spellings. Interest payable. All right. Why is it interest payable or an accrual? This is because we did not pay for the interest. It is due to be paid. So it is a liability. We need to pay it in the near future. We only paid half of the interest. The interest was supposed to be 20,000. That's the interest charge. However, we only paid 10,000. The remaining 10,000 is the interest payable. Are we together? Fantastic. All right. So that's one of your workings. All right. Then you have to look for other workings because the examiner does not tell you. Okay. You just have to lead yourself. You lead yourself down the terrain, okay, or up the terrain. Now let's look for other workings. So for you to know which workings are relevant and not, you also have to combine the figures provided with also the notes to the financial statements. Sorry, I'm trying to optimize the view, but anyway, it seems like my machine is resisting that. All right, so but I hope you are seeing clearly. All right, so let us try to go to the next issues. The additional information is also useful, and in the examination you just have to capitalize on the additional information for you to get some clues on which workings must I struggle with, because you just have to give yourself just 10 minutes of the work, 5 minutes to 10 minutes doing out these workings. So let's read additional information. Number one, sundry expenses include 9,000 paid in respect of insurance for the year ending 1 September 2028. Now, they are saying that the sundry expenses figure you are seeing in the list of figures, right? You come here and say, sundry expenses, where are you? And you see that this is the line for sundry expenses, and they are being shown as 113. The reason why I'm taking these figures is because I want you to see, to avoid duplication in the examination. What you have actually done, you just have to shade it or to color it in the computer-based examination. You just have to color it or to shade it, whatever format you might use, so that you won't duplicate your efforts. All right, you just have to know that this figure is done. All right, so sundry expenses 113,000, but they are saying this figure includes 9,000 paid in respect of insurance for the year ending 1 September 2028. Okay, so what is 9,000? 9,000 includes a prepayment. Okay, 9,000 was for our year end. Remember, according to the question, the year end is 31 December. Okay, 31 December is our year end. Year end 31 December. Okay, but insurance was also paid for the whole year, 12 months, but it was ending on 1 September. All right, next year, this was the year end was 20x7, but the insurance was paid for the year ending 1 September 20x8. All right, so you can see that the 12 months here for the insurance, the 12 months for the insurance started the previous year. All right, so it started the previous year somewhere around 1 September the previous year. Okay, 1 September the previous year to 1 September this year. So I meant to 1 September 2008. So it started 1 September 2007 to 1 September, or let me just say to 31 August, all right? 31 August 2008, something like that. Okay, so those were the 12 months, all right? So if you look now in 2007, how many months should be considered? Because the other months are spilling over into the other year. So those months spilling over, the payment that was made for a future expense was a prepayment. So how many months were for the expense was only for how many months? Expense was for only 4 months. Okay, 4 months. Are we together? 4 months. Let us count these months and see if they were really 4 months. We are saying that it started on 1 September the previous year. That's when the insurance cover started. 1 September 2007 to 31 December 2007. 31 December 2007. So from 1 September, 1 September, we are saying September, October, November, December. So you can see that this is 4 months. So the expense was for 4 months. Then the prepayment was for how many months? From 1 January to 1 September, or to 31 August 2008. That's 8 months. Are we together? So 8 months was the prepayment. Then 4 months was the original expense for 2007. So that is the adjustment you need. So you are being told that this 9,000 should be apportioned. The $9,000 should be apportioned between the prepayment and the expense for the year. Okay? It should be apportioned between the prepayment and the expense for the year. So the expense for the year. All right. So you come and say, working number 2. All right. You can just say a year. Prepayment. In brackets, this you just have to relate which item are we referring to, because there could be many prepayments. Sundry expenses. Okay, so prepayment, sundry expenses. Sundry expenses. We say how many months? 8 months over 12 multiplied by 9,000, which gives us 6,000. Okay, then you can then say sundry expense, charge. Okay, for the year should be, now we know that we have listed 113 as seen here, so we then have to say we deduct. Okay, we need to remove the 9,000. Sorry, not the whole 9,000, but the 6,000 actually. We remove the 6,000 and we then have to be left with something smaller there. All right, so that's 113 minus 6. How much is that? 107. All right, you pause it at this level, but you may discover that you also need to adjust it as you go with your workings. All right, let's move on with our notes. So we have done the sundry expenses. Let's keep on reading the first note. Light and heat does not include an invoice of 3,000 for electricity for the 3 months ending 2 January 2007. So you can see that this 2 January 2008, although it is related to the next year, it can be materially be inferred to just mean that it is still the same period, the 2007 period. So you need to just know that the 3,000 referred to here was an expense for the year 2007, but it was not paid for. So they didn't pay for this because this invoice was not included. The 3,000 invoice was not included. So you say your working number 4. Working number 4, accrual. Accrual. I've seen that in this patient there are a lot of accruals, the interest expense and so forth. So you can just merge them. All right, accruals. Then you say the first one is light and heat. You put the amount which was 3,000. Okay, you can just put your $ thousands so that the examiners will not get paranoid for your for your omission. Then remember we talked of the interest accrued. Okay, interest accrued. We determined that it was $10. It was 10,000 from our first working number 1, and then we are also told somewhere in the question, if you go down the notes, you will also know that there was an accrual somewhere. All right. Remember, this was a tip. Management wished to provide for loan note interest due. Remember, this was there was an interest due. Okay, and that was the 10,000 we worked about. And then a transfer to the general reserve. We'll talk about this. We'll talk about this one separately. But this one, audit fees of 4,000. These were outstanding fees. So you just have to make reasonable judgments. So audit fees, I think these were all the accruals. So if you add up these 3 figures, you can come to a total of 17,000. So you are done with your accruals. You're now safe and sound. You move on to the next aspect. All right, now let's continue reading. Light and heat also includes 20,000 relating to salesman commission. You can see that the adjustment for light and heat is actually complex, and you then have to ensure that in that balance you remove the 10,000. I mean the 20,000 for the commission. It was posted in error. That's an error of commission. It was a direct error. Okay, wrong posting. So you then have to ensure that when you are preparing this light and heat, so we can actually come here and say light and heat charge or expense. So we light and heat as given. All right, we go to the figures. The light and heat are here. This is the line. Light and heat, we are told that it was 31,000, but we need to adjust. So we say 31, okay, and we remove the salesman commission of 20,000. All right, but we need to add the invoice which was omitted, which we determined here as 3. So plus 3. So if we do that, how much do we get? we get 14. So this is the figure, the adjusted figure for the light and heat expense. Okay, so you can see that there's no need for any rocket science whatsoever. Just have to lead yourself using pure mathematical logic. Okay, we are done with item number 1. Let's move on to item number 2, which I guess imposed a lot of challenges on most of you. The suspense account is in respect of the following items. All right, proceeds from the issue of 100,000 ordinary shares, 120. Proceeds from sale of plants, 300,000. Remember, the suspense account spoken about is here. Okay, this is the figure. Let me just try to underline so that you guys want to be okay. A suspense account of 135. So the notes are explaining the suspense account, this 135, where it came from. All right, so we are being told that there were proceeds from issue of 100,000 ordinary shares. There were proceeds from sale of plant. They disposed of a plant and they got something. So when they issued the shares, they got 120,000. When they sold the plant, they got 300,000. So this gave a total inflow of 420,000. However, they also purchased a company. So they have got a subsidiary called Mary and Company, which they paid 285, and what was left was $135,000. That was the amount that was left in their coffers. Okay, now you need to account for this. All right, you need to account because there are a lot of things that come up with the type of information you are seeing there, which have got a bearing on the financial statements. Are we together? So first of all, let's do it systematically. Let's start with the proceeds from the issue of 100,000 shares. What is the implication? All right, right, let me just say this is working number 6. Working number 6. I'm trying to work around the figure so that you can easily grasp the concepts. But in the examination, you need to be very systematic on your spreadsheet as you do your workings. They should appear chronologically and neatly so that the examiners won't struggle to give you marks. So working number 6, let us talk of share issues. Share issue. Now, share issue has got two things here. You need to be led by the nominal value of the shares. So if you come here, this is where we have got figures related to the shares. These shares have got a nominal value of 50 cents. 50 cents. All right. So the nominal value is the first item that is to come into an ACCA student. What was this nominal value? So nominal value, 50 cents. Okay, but how many shares were issued? 100,000 ordinary shares. So 50 cents times 100,000. This gives us, remember you put your dollar sign, $1,000. So 100,000 times 50 cents, that's 50,000. But how much were the proceeds? Okay, the proceeds were 120. 70,000. So they obtained 120,000, all right, on the shares which were worth 50,000 nominally. The nominal value was 50,000, but the shares brought about or fetched 120,000. So they made a gain when they issued these shares. They made a gain of how much? 100,000 minus 50,000, that's 70,000. Remember, I'm sorry, we had already put some $sign thousand here, so we just have to work with these figures. Otherwise, we end up having an incorrect answer. So 70. So this 70,000, there is the gain after a share issue. We technically call that one share premium. That's the share premium. All right. You could just for good presentation, you could have started with the share proceeds minus the nominal value, and you get your 70,000 nicely. So don't mind the the issue of number direction. Okay, the operation sign, the negative, and so forth. Ignore those ones for now. This is not mathematics, it's accounting. You just have to know the meaning of the figure. All right, just have to lead yourself that this is share premium. All right. Okay. All right, I hope I'm not offending you guys, but that's it. So that's the share premium, 70,000. All right, but I'm sure, and I'm very confident that you are getting the idea, because you mustn't be vexed when you look at these longer questions and then you start to say, oh my God, where do I start? Jerry, where do we start? No, this is the tip, guys. Just have to cling to it. Just cling it. Okay. Now let's move on to the other part. We did the proceeds of the share issue. What about the item related to the proceeds from sale of plant? They sold a plant. Okay, they sold a plant, and they fetched how much? 300,000. Okay, because this was the amount they fetched, 300,000. Now our task is to know, how do we have to go about this plant issue and so forth? Because without knowing that, we are going to struggle with this particular question. How are we going to deal with so the first thing that has to come to our mind is working number 7, the plant. Okay, you can just say plant. The plant. Now let's start worrying about profit on disposal, profit or loss on disposal. All right, profit on disposal. All right, now the proceeds were how much? Profit on disposal. Let's start with the proceeds. The proceeds were 300,000 as given here. We saw that there were 300,000, right? Those were the proceeds. Now it's proceeds less NBV. How much was the NBV, the net book value of the plant? All right. How much was the net book value of the plant? So the question should actually tell us, because let's read the question again to see the net book value of the plant. So here we don't have the information. All right, we need to look around. Item number 5. The plant which was sold had cost of 350,000 and had a carrying amount of 274,000 as at the start of the year. Then a depreciation of 36,000 is to be charged for this plant for the year 2007, for that current year. So the net book value was that much. When the plant was sold, that was the net book value. Are we together? Now, you just have to know that profit on disposal is calculated as proceeds from sale less the net book value. That was the major game changer, okay, or the major weapon to ask the question. Because if you don't know the formula, you are going to be dazzled overboard. So that's 274. All right. Then you get the profit on disposal of 26,000. That was the profit. You move on with the question. All right. This is just the beginning of your workings. You then have to say, how much depreciation do I have to consider? But now, for depreciation, you have got two items. You don't have the plant alone. You also have the buildings, because in the question, we are given the non-current assets information here. We've got land and buildings and then plant. So we have done the part of the plant that was disposed of, and we are also told the depreciation charge for the plant that year. All right. So you then have to calculate depreciation related to the building and depreciation related to the plant. You combine the two and you get the total depreciation for the year. Now, let's start the workings. I think we need more space to do that. So that's working 7, continued. Okay, working 7, continued. But all right, let us just say working 8, because we might end up confusing ourselves. Okay, let us just say depreciation charge. Depreciation charge. Now, okay, let's move to the question. For more information on the depreciation, all right, let's start with the buildings. If you go to item number 4, this, sorry, the pen now starts its tricks. Okay. Item number 4 is saying that the property was acquired some years ago. The buildings element of the cost was estimated at 100,000 and the useful life of the assets was 50,000. Was 50 years at the time of purchase. All right. So if the life of the building was 50 years and the cost was 100,000, this means that the annual depreciation can be calculated. And how much is this depreciation? You then have to say, you come to your workings and say buildings. That's $100,000 divided by 50 years. Yeah. Divided by 50 years and you get $2,000. So every year they were charging 2,000 as depreciation charge annually. However, we are told that at so this is the charge for the year, okay? But you may go a step further and just say, therefore, net book value of buildings is equal to, so I mean, you give a date at 31 December 20x7. At 20x7, the net book value of the building was how much? You then have to say 100,000, okay? The 100,000, the original cost minus, okay, you can just minus, if you go back to the question, you can see that there was information about the accumulated depreciation, which was 20,000 at the start. Remember, this was at the start of the year. At 1 January 20x7, it was 20,000. So you need to put that one again, minus 20,000, minus this figure, 2,000. And you get your ultimate net book value of buildings. Okay? Okay? Okay, so 78,000. However, I want you to appreciate one thing, that this clause is saying that the property was acquired. The property, the word property is a technical name referring to both the building and the land. We only calculate depreciation. I mean, we only calculate depreciation on depreciable assets. Land is not a depreciable asset. So this is why I only calculated depreciation on the building part. All right. So if we go back to the figures, you can see here that land and buildings at cost was how much? It was 430. All right. So which means this 430 includes the 100,000, the cost of the building, and the balance, which is the cost for the land. And I said that we do not calculate depreciation on the land. Land cannot be depreciated. That's the accounting belief. Okay, so you come here and say total NBV for property. Okay, the total, all right, let me just say, let me erase this and say land value. Okay, land value was, obviously this is equal to 430,000 minus the 100,000 for the building, which is equal to 330. All right, so the land is 330. So if we add the land value plus the net book value of the buildings, it means that the total value of the property is equal to 408. Is it so? Yes, 408,000. Why is this figure important? Because we, in the statement of financial position, would want to know the value of the property. and that was the value of the property. But this value, mind you, this value was at 31 December 20x7. We are also told, remember, your mind should be very attentive to detail. We are then told that as at 31 December, the property is to be revalued at 800,000. So which means that you then have to say revalued to 800,000. This is now the figure we would want to see in the statement of financial position. All right. So if the figure was revalued to what is the balancing figure here? The balancing figure should be how much? The balancing figure is 800,000 minus 408. Let us use our calculators and see if we can come up with a figure that speaks sense. That's 392,000. And we take this one to the revaluation reserve. It's a revaluation gain. Revaluation gain, which is taken to the revaluation reserve. Are we together? That's for buildings. All right, that's for buildings. The gain is taken to the revaluation reserve. Okay, so basically the depreciation charge for buildings is 2,000 every year. All right, it's 2,000 every year. All right, in as much as the year 2007 is concerned. All right, but since from 2008 going forwards, then it means that the charge will be different because we have revalued the property. I mean, yes, we have revalued the property, so this means that the charge could be affected as well going forward. All right, I think that's a better explanation for that. All right, now let's now talk of the depreciation charge for the plant, because here we have only done for the buildings. So let's talk of the plant and see if we can come up with something sensible. All right, so for the plant depreciation. Okay, now for the plant, we just need to know the background of the thing here. All right, sometimes it's not as straightforward as you think. All right, you just have to work around your way until you reach to your destination. Now, one thing we want to know is the cost of the plant, cost of the remaining plant first. What is the cost of the remaining plant? We are given these figures, okay? We're given the figures in the question, all right? But they are not as clear-cut as you might want, all right? Initially, the balance is at the 1st of January was 830 for the plant and the machinery. It was 830. That was the cost. All right. And the accumulated depreciation was determined to be 222, which is those figures, you might need them, you might not have time to roll up and down. So 830 was the cost of the plant at the beginning of January 2007. Okay, 830. Keep that figure in mind. So cost of the plant 1 January 0.x7. This was how much? Let us put a dollar sign here, 830 dollar thousands. All right. But we also told that this the plant which was disposed, had a cost of how much? 350,000. All right. So the cost of plant disposed was 350. All right. So the cost of the remaining plant obviously is the balance there, which is 830 minus 350, that's 480. That was the cost of the remaining plant. Now we then have to then maneuver our way. All right, we need to maneuver our way. So once you have done this, I want you to put a star here. The pen might not be visible. All right, just put a star. That figure is the cost before any adjustments to the depreciation. Okay, let's calculate the depreciation so that we arrive at the net book value, which should appear in our records at the year end 2007. Okay, that's the remaining plant. We need then to adjust that figure with the depreciation. Now let's calculate the depreciation charge. Okay, now for the depreciation, we had figures at the beginning of January 20x7. All right, we had an opening balance for the depreciation, accumulated depreciation. Sorry, the noise outside there is too much. All right, so the accumulated depreciation was 220. I said you need to mark this figure, 220,000 to 22 thousand. Remember, dollar thousands. And then we also need a figure on the charge for the year. Charge for 2007, and this one was given. The examiner had given us, and from the notes, remember, we're told that we need to use a specific figure, 36,000. All right, but this 36,000 was for applicable assets or assets which were still in the business. Okay, this was the charge for those assets which were still in the business in the current year. So it was the current year depreciation. However, there was depreciation on disposed assets, which should be removed. Depreciation on disposed assets. Depreciation on disposed assets. All right. So when the assets were sold, they had already accumulated some depreciation. So we need to account for that. We need to account for that. So remember, we then have to say, what was the cost of the asset which was disposed of? The cost from the question, as we have already determined, the cost was 350. All right, this was the cost, 350 minus how much was the carrying amount. Remember, this is the cost of the asset. Cost of the asset. Now we want the net book value of the asset when it was disposed of. So we know that from the notes, this asset which was disposed of was having an NBV of 274. NBV is the carrying amount. So 274,000. Sorry. So 274,000. So which means the depreciation here, the difference is the depreciation. Okay? The depreciation. Right? That's the difference. So the depreciation there should be 350 minus 274. This should be 76. And this depreciation should be removed. Okay, there is lightning. All right, let me just finish this video. Okay. So we get 182,000. Okay, so we have done much of the workings which were required, and we can now then be confident to say we can start our financial statements preparation. Okay, so I talked much about the accrued expenses. We might want to just amalgamate them, I mean to group them closer so that we have a figure, all right, which we might call the figure which you might refer to as the total accruals. Okay, and I've indicated that good, that's 17,000 as you can see here. Sorry, my machine is misbehaving, and it's very scary outside. There's a lot of lightning, and oh man, it's very intimidating, but I'm sure you are seeing everything now. I'm trying to, to minimize and make sure that everything appears on the screen. Okay, let me try to adjust again. Are you happy now, ladies and gentlemen? Okay, let me try to resave. Oh, still misbehaving. Sorry for your time, guys. Okay, uh, so this is the thing. We have done much of the workings that were required. I'm sorry, I'm taking a step-by-step approach, which means it consumes a lot of time, but I know it's worth it, all right? It's worth it. There was something that was spoken about a subsidiary, which might be of interest to us, all right? Um, there was this subsidiary, Miracle, which was procured um, by this company. So we need to calculate whenever there is a subsidiary during the year, we need to calculate what is called goodwill. So for goodwill, you just have to know the formula first because you cannot guess it out. So this might be working number 9, goodwill. And here we say fair value of consideration transferred, and we are told in the question that they paid how much? From the suspense account, they paid 285. So 285. Remember to put your $1,000. 285, and then you then have to say NCI at acquisition. All right, you add the NCI at acquisition. All right, but if you are not given much of the question, you just have to use the fair value of the assets. All right, so the fair value of the asset was how much? So it's just consideration transferred minus the fair value of the assets. Sorry, fair value of assets less fair value of assets. The assets figure or values from the question were 265. Okay, those were the assets of the subsidiary when it was acquired. 265 in total. So therefore, the goodwill was 20. Okay. All right. Then, do we have any other item which is outstanding from our notes? There is this animal. Okay. Transferred to general reserve, 16,000. So do we have any information in the notes, I mean in the financial statements which relate to the general reserve? Okay, we have got this, the general reserve. So the balance was how much? Was 171. So this is to be adjusted. So you can just say working number 10. Working number 10, general reserve transfer. Working number 10, general reserve transfer. Okay, original balance was 171. However, there is a transfer of how much? 16,000. So obviously we are going to rest at 187,000. Remember to put your $1,000. Okay. So this, I mean, these were the workings, and I'm sure you are happy with them. You are happy with the workings, I'm sure. Then the working number 8, all this, yes, yes, all right. So Fantastic. That's the information, ladies and gentlemen. So these were the workings. I'm sure we are all happy. Now, let's do the statement of profit or loss. All right. There were two major workings. I just say one. We did not calculate the cost of sales. That was a major working, which I ignored, okay, for reasons I do not know. Working 11, working 11, cost of sales. All right, so the cost of sales starts with the opening inventory. The opening inventory, ladies and gentlemen, from the question, from our figures, this is the opening inventory. The opening inventory was 190. Okay? Remember to put your thousands. So 190. Then add purchases. All right? So the purchases figures we have from the question, the purchases 2152, but we acquired a subsidiary which had already inventory within it. They also had inventory. So they had inventory, this figure of 34. So we add that inventory of 34 and we come up with 2. Okay, like I'm saying, they had purchases of 2152, but we also have to include, okay, we have to include inventory from the subsidiary as part of the purchases. Okay, it becomes part of the purchases because when we acquired the subsidiary, we also purchased its inventory. Okay, technically we have purchased further inventory. So that's why we are adding that inventory to the purchases. Okay. Now somebody might be inquisitive and start to say, so if we add inventory there, why are we not adding the equity as well? Equity investments. Now, in consolidation, only the parent's equity is considered, not the equities of the subsidiary. Why? Because the equity owners there no longer exist because they were acquired. The only equity that is in existence is that of the owner, of the parent. Are we clear there? So that's the standard. We only account for equities of the parent. So let's move on. Let's move on. It's scary outside. There's lightning, but I hope I'll soldier on. But then I have to say, less closing stock or closing inventory as given in the question. The closing inventory, according to the question, was how much? It was written somewhere. 220,000. Sorry. So we get our cost of sales and this should be 2156. Okay. So we come here and say statement. We can just say the name of the company, Wilson Co. Consolidated statement of profit. Okay. Consolidated statement of profit or loss and other comprehensive income. Like I said, we start with the revenue figure. Okay, the revenue figure was given. So you need to be having eyes to locate the revenue figure. The revenue figure is the sales figure. The sales figure 2695. Remember to put your 1,000. 2695. The other figures you cross check on your question. The cost of sales, you write in full. This is working. You have to indicate where you did the working. That's working number 11. This is the figure. Working 11. That's 2156. This is a cost, so put in brackets. So if you deduct that cost from the revenue, you get what is called gross profit. So the gross profit becomes 539. Then there was profit on disposal. We call that one other income. Other income. All right. Bracket profit on disposal. You can indicate is working number. I don't know the working number now. Right. Okay. Just for avoidance of doubt. The profit on disposal, we calculated it as 26. That was working number 7. The 26 is here. 26,000. Working number 7. 26. It's a positive figure. All right. Then you can say wages and salaries, sundry expenses, light and what. We can group those. All right. We can group those workings. Let me create some space. Let me just say working. Let me create a space here. That's working number 12. Working number 12. Let us just say admin expenses. Admin expenses, because your statement should not be crowded, should not be cluttered with a lot of information. Remember, these financial statements are summaries. So we can just say for the wages and salaries and commissions, what, we just put one figure. All right. So remember from the question, from the figures, we had these wages, salaries of 254. We just have to add the commission there. The commission of the salesman, which was misposted of 20,000. So we are saying 254 plus 20, and this becomes 274. Okay, and then the sundry expenses, we talked about these ones. Sundry expenses, where we say that the sundry expenses was initially 113, but there was a prepayment. Okay, there was a prepayment of 6,000, which is to be removed. Remember when we did our computations there. because we were told that the sundry expenses included 9,000 for the insurance, which was paid, which was ending in September the next year. So only 3,000 was valid, okay? But 6,000 was not valid, was not an expense for the year. So it was a prepayment. So we need to remove the, excuse me, we need to remove the 6,000, which we said it was a prepayment. So the 6,000 is to be removed. You can as well be cosmetic. It's not cosmetic actually. That's the real deal. You can indicate the working number there. You can just say so that the examiner, you say working number 2, okay, so that they see where you get that 6,000. So that's 130 minus 6,000, that becomes 107. 107. And then the light and heat, this was a specific working, and we did the working. We can't repeat what we did in the exam. They want to be that time. We found 14 there. That's working number 5, isn't it? Working number 5. So light and heat, that's 14. Sorry. Working number 5, 14. Okay, then depreciation. When we calculated depreciation, I think I forgot one thing. Okay, for the depreciation, I think I forgot one thing. Okay, this 36,000, the 36,000 is to be taken to the SPL, statement of profit or loss, as a charge related to the plant. Okay, the plant and machinery. And I also indicated that the 2,000 is for the buildings, again to the SPL. Okay, then the 182, this one is accumulated depreciation at 31 December 20x7. Okay, that's accumulated depreciation for the plant and machinery. All right. Done. All right. So remember, we are still at the statement of profit or loss level. So we are going to take the two figures, the 2,000 for the buildings, this one, as well as the 36. All right. This 36. So we come here and say, sorry, depreciation, this is 2 plus 36. All right, 2 plus 36, and we get 38. Then the other fees, they are the audit fees. The audit fees are given in the question. They're given in the question as 4,000. All right. So we add these figures up and we must get our 437. So this is the figure for the admin expenses in total. So we take that one as admin expenses. That is working number 12. Okay, working number 12. And we said it's how much? 437. Okay, then we calculated the interest cost. We call those ones finance costs or finance cost. That was working number, I think it was working number 1, our first working. The first working, yes, working number one, it was 20,000. Remember, we used the matching concept. Working number one, 20. It's a cost, so we put in bracket and we get our profit for the year. The profit for the year becomes 108. Remember, we start from here, 539 plus 26 minus 437 minus 20, and you must get your 108. Excuse me. Now that we have found the profit for the year, we then have to add a section, other comprehensive income. The other comprehensive income here only contains the gain on revaluation. Gain on revaluation. We calculated this as working number one. If you still remember, when we calculated the gain on revaluation, where we determined that the property is to be valued at 800,000. Remember, our gain was that one. That was our gain, 392. Sorry, I did not get the working number. Sorry for that. That was working number what? Working number 8. Okay, so working number 8, 392. All right, and then we get what is called the total comprehensive income, which is 500. 500. Okay, so you are done with your statement of profit or loss. All right, and I hope you are fine, you are getting everything. You start with the name of the company and then the name of the financial statement, which is the consolidated statement of profit or loss and other comprehensive. Okay, so I just want to emphasize that this statement of profit or loss and other comprehensive income can also be called the statement of comprehensive income. All right, statement of comprehensive income. All right, so which means that we have analyzed this statement in both its parts, or in its two parts, or in its components. Like, for example, the first component was for the comprehensive income, which starts from the revenue up to the profit for the year. Okay, so from this going down to this part, that's the comprehensive income section, and then from this, this is the other comprehensive income section. So this is why it is called the statement of profit or loss and other comprehensive income. So you can refer to this statement as the statement of comprehensive income. Now let's move on to the statement of financial position. If I still have space, I think I'll try to squeeze everything. All right, so let us use a different pen. So statements of financial position. Remember, the statement of financial position is given as at, okay? It's written as at. Statement of financial position as at 31 December 2007. All right, but the statement of profit or loss and other comprehensive income is written for the whole period. Okay, so it's for the year ended 31 December 2007. Okay, now that we have done that, let us do this. So like I said, the accounting equation says that assets should equal to capital plus liabilities. So we start with the assets. The assets for this company were grouped into non-current assets and current assets. All right, the non-current assets included property, plant, and equipment, which was comprising of um, the property. Okay, the property was revalued, so the property at valuation. The property at valuation, the revalued amount was 800,000. Remember, we are using thousands. Okay, we can have another column just in case. Okay, and then we have got the plant. Remember, the property I said was for the land and buildings, but the plant and the machinery can be shown separate. So we have already calculated, okay, we didn't actually, we determined that the plant's cost was 480 according to working number. If you still remember, guys, the plant, all right, the plant, I put a star here. This is the cost of the remaining plant, 480, all right? And I said we need, this is the accumulated depreciation. The cost was before adjustment of the accumulated depreciation. So 480 minus 182, that's the figure we want. Okay, 480 minus 182. So what was the working number? Sorry to drag you. All right, so this was working number 8. So working number 8 was very, very, very long. Working 8. So minus 182, which is again working number, is it working number 8 again? Yes, it's working number 8. It's still the same working 8 as well. Okay, so that gives us 298. All right, then we also have goodwill as an asset. This was working number 10, I guess. We did this calculation toward the end of our workings. Working number 9. So that's working number 9. And the goodwill was 20. Okay. We then have to also include what? Okay. Okay, just a cross check to see. Okay. Oh, I still have to make this correction for you. Be with me there. Equity investments. When I was giving my explanation a while ago, just be with me. I indicated that during consolidation or in consolidation, we do not have um, to include or to add the equities of the subsidiary to those of the parent. Okay, excuse me. Okay, so the explanation I think I need to put across is that it was just an error of sight. Okay, the equity investments are not equities. All right. So while the explanation was correct to say that equities of a subsidiary are not going to be included as part of the consolidated equities of the group, equity investments, on the other hand, these ones are investments which are treated in terms of IFRS 9. All right, IFRS 9 financial instruments. All right, so these are instruments which create equities in another entity. They are different from ordinary equities, which are accounted in a different way. So these ones have to be treated the way we treated the inventories, as we included the inventories as part of the purchases when we were purchasing the subsidiary. These ones also become assets of the group. All right, so they are financial assets and have to be treated in terms of IFRS 9. Okay, so we then have to consider this value, the 231 has to become part of the assets. All right, so the 231 becomes part of the group assets. So we put them under the goodwill here. For equity instruments, these ones, we just take the 231 as it is. Okay, then I think the non-current assets are fine. We then have to move to the current assets. In the exam, please don't write these shortcuts. Just write full name, current assets, proper plant and equipment, and so forth. All right, so here we've got inventories, the inventory. Now the inventory figures in the question, we were told that inventory at 31 December was valued at 220,000. Okay, so that statement is express and explicit. You just have to use that figure for your inventories. So 220, just take it as it is, 220. All right, then we've got usually trade receivables. And there were no notes talking about trade receivables, so we go straight to the question. To the figures as given on the list of balances. So trade receivables, they were 179. So we take that figure straight away, 179. Prepayments, we talked about these figures. Prepayments, that was working number 1. No, it's not working number 1, where we talked of the insurance and so forth. Is it working number 1? Let me check. Where we talked of the insurance, the 6,000. Okay, yes, working number 2, 6,000. So working number 2. Then cash. The cash figure, we go to the list of balances. Do we have cash somewhere? Yes, 126. All right, so we get the total of current assets is 531. Then we get the grand total total assets. So if we add all these figures, 800 plus 298 plus 20 plus 231 plus 531, we get 1,880. All right, so that was the first part. Now let's go to the equities and liabilities. The equities and liabilities, we start with the equity. So the 50 cents ordinary shares, as I've already indicated, we only take the shares of the parent. And in the question, these were given as 450,000. Okay, but we issued further 100,000 with a nominal value of 50 cents. Remember, that was so. Okay, let us first take this one, 450 plus 50,000, which was working number, if you still remember, where we talked of shares which were issued, where we calculated the share premium. Remember, that was working number 6. We said the nominal value of the shares was 50,000. So working number 6, 50,000. So they become 500. All right, then share premium. Share premium on working number 6, we determined it to be 70. All right, then there was revaluation surplus. Revaluation surplus. And the revaluation surplus, we determined it to be 392. That was working number how much? Remember, we also accounted for this revaluation, this one. That was working number 8. Okay, then we need to talk of the general reserve. This is the equities section. Okay, remember the heading was equities and liabilities, but right now we are still on the equities. So the major heading should be equities on top here, equities and liabilities. But we are still on the equities section. So general reserve is also an equity. And the general reserve, we had calculated it on working number, this one, working number 10. Working number 10 is 187. Okay, then retained earnings is also an equity. Retained earnings, sorry, earnings. These ones we just take as they are given in the question. Retained earnings, okay, we add them up, we get 1468. Then we go to the non-current liabilities. Non-current liabilities, these were for the, because there's no space, let me just say, write them, continue here, 10%. Loan stocks, loan notes, okay, it was 200. And then we go to the current liabilities. The current liabilities, we have got the trade payables. Trade payables is given in the question. In the question, they check the figure on the question. You have the question. We have got 195 in another column. And then we also have got accrued expenses. We calculated the accrued expenses, remember, where we got 17. That was working number, where we obtained, I think, working number 2, somewhere there. Working number 4, this one, 17,000. Working number 4, sorry. So we add up, we get 212. Then we add up and we get the total equities and liabilities. Total equities and liabilities. Remember, equity is another word for capital. So if we add this figure and this figure and this figure, we get 1880. So that's why this was our statement of sorry. These are the figures for the statement of financial position. These are the assets. Okay, the heading, the assets. The asset side should be equal to the equities and liabilities side, as you can see there. Okay, so that was the first question, and I hope you have been assisted. Any questions, please don't hesitate to contact me. This is why you pay me, and my purpose should be there to ensure that you have mastered the concepts, you have mastered everything you need to pass the ACCA paper financial reporting. So until next time, ladies and gentlemen, please continue to feel excited, very, very excited. I am signing out. Thank you.